Have you ever made a trade only to watch the market go in the opposite direction and leave you with a loss? Or have you sold a position too soon only to see the price continue after you got out? If so, you're not alone. My name is Oliver from Lux Trading, and today I'll explain to you why many traders fall into the trap of selling low and buying high. And trust me, it can get really costly. But why do we do it? Stick around and find out. The answer lies in our psychology. As human beings, we are prone to certain biases and emotions that can cloud our judgment and make us make foolish decisions, honestly. In the world of trading, these specific biases can be extremely damaging. One bias that contributes to the tendency of selling low and buying high is the sunk cost fallacy. This is when we hold on to a losing position for too long because we do not want to accept a loss. We hate to accept that we've made a mistake and we are losing the money that we have invested. Instead, we hope that the price will turn around and eventually we will make a profit. But often, the longer you hold onto a position, the more you stand to lose. Another bias that can lead us to sell low and buy high is overconfidence. When we're feeling confident in our abilities, we are much more likely to enter a trade without actually considering all of the risks involved. This can lead us to hold onto a position for too long as it starts to lose value, because we believe that we know better than the market. On the other hand, when we feel uncertain or not confident, we might be likely to sell a position way too soon, even if it has good potential to continue rising. A third bias that can contribute to this behavior is the herd mentality. When we see other traders making a move, we feel pressured to follow along, even if it goes against our own judgment. This can lead us to buy high when the market is overheated and sell low when there's a panic. So, how do you avoid making these decisions and falling into those traps? One way is to have a solid trading plan. I know, I keep repeating this on this channel, but it is very important. A good trading plan should include your entry criteria, your exit criteria, and your risk management strategy. By following a set plan, you can avoid letting emotions do your decisions for you. Another helpful approach is a part of psychology. It is practicing self-awareness and mindfulness. Take a step back and check with yourself before making a trade. Are you feeling overconfident or uncertain? Are you letting your emotions or actions of others influence your decisions? By recognizing what you feel, you can make an effort to overcome your biases. Finally, it can be helpful to seek guidance of others or a personal mentor. By surrounding yourself with experienced traders who can offer a different perspective, you can gain a more well-rounded understanding of the markets and make more informed decisions. If you'd like to check it out, we have started offering private mentoring sessions. Check out our website under the Elite Traders page. You'll be able to find one that's called Private Mentor. And now, in conclusion, the tendency to sell high and buy low is very common amongst traders. By understanding the psychological biases that lead you to it and being aware of them, you can make a much more reasonable, profitable trade. I hope you liked the video. If you did, don't forget to like it, share it. If you'd like to see more content like this, subscribe to our channel. And if you want to get in touch with us, feel free to reach out to our 24/7 live chat or send us an email at info@luxtradingfirm.com. Mine has been Oliver. Thank you for watching, and as always, have a great one.